How to avoid personal liability if you're closing down your limited company. Chris Worden, First Business Rescue. This video is aimed at you, the UK business owner whose business is starting to face financial difficulties. You're considering insolvency for the business, you're considering liquidation, administration, and you want to avoid personal liability. So I'm going to go through some notes. I'm going to help you understand personal liability and how you can actually safeguard yourself. Now, what does personal liability mean? Well, listen, in essence, it's when you, as a company director or owner, could become responsible for some or all of the company's debts. Now, normally UK limited companies protect the director by limited liability, meaning the debts belong to the company. But there are situations where these lines kind of blur. Now, this is how you safeguard yourself from personal liability. When things become difficult, you've got to act early and seek advice. So as soon as you sort of see for financial trouble, speak to your accountant, reach out, get insolvency advice. You can speak to somebody like us, free, independent and off the record. Number 2, keep accurate financial records. Very, very important. Always maintain up-to-date books. And I've mentioned this on lots of videos, up-to-date financial information is really important. Xero, QuickBooks, Sage, just to name a few. And keeping those records up to date so you can see snapshots of your business that are accurate. There's no point looking at accounts from 18 months ago. A lot's happened since those 18 months. Number 3, try and avoid personal guarantees where you can. It's so easy when business is going well to put your name to a personal guarantee. But you've got to remember, I see the other side of that. Business, who saw COVID? Who saw bloody interest rates going to where they're going? Who saw, gas and electricity prices, going through the roof? Try and avoid personal guarantees, and just so you know what a personal guarantee is, it's a promise by a director to pay back the company debt that they've personally guaranteed out of their own pocket if the debt goes into default. Number 4, try not to trade while you're insolvent. Just explain that. What does it mean if I'm insolvent? If you can't pay your debts when they fall due, if you can't pay HMRC, you've got huge arrears, you're failing on time to pay, your suppliers are threatening to wind you up, you're insolvent. If your liabilities are more than your assets, you're insolvent. If a supplier has got a CCJ against you or a stat demand or they're threatening to wind your business up, you're insolvent. So at that point, you've got to take advice. If you become insolvent and you keep on trading past that point of no return, that's where you could land yourself in trouble with personal liabilities. Number 5, ensure your director's loan account is clear. So for those that don't know what a director's loan is, a director's loan is like it's a track on money that a director has put into the company and then taken out. So every credit that you make into the business goes and that could be money at the start to get the business going, money that you lend the company to buy assets, machinery, whatever. It goes as a credit against your director's loan account. And every bit of money that you take out of the business goes as a debit. Now, once a year, your accountant will look at your accounts and they will hopefully declare a dividend out of profits made, which will clear your director's loan account down, hopefully to 0. But if your business is starting to fall on hard times or you've taken too much money out of the company, you've used it as a personal cash machine, it's highly likely your director's loan account is going to be in debt, which means you as the director owe the company that money. And if you go into liquidation, an insolvency practitioner is going to request that you pay that money back to the liquidator. Right. Number 6, follow formal liquidation procedures. So if you decide to close down the company, it's really, really important that you use a formal liquidation process. And this will ensure that all debts are correctly dealt with. You are acting properly as a director. You know, what I'm telling you not to do is don't resign as a director in the 89th minute of a 90-minute match. Don't take up one of these firms that are going to buy your insolvent company. They're not going to buy your insolvent company. There's something wrong with it. Don't try and strike the business off. You know, if you're insolvent and you need to get into liquidation and you're advised by professionals to go into liquidation, follow that advice. Right. Number 7. Number 7, understand your responsibilities. You know, I could ask you to sort of familiarise yourself with the Companies Act and other legislation, but I don't think you're going to do it. So I'll give it you in a nutshell. When you become insolvent, remember, can't pay your debts on time, liabilities more than assets, someone's taken legal action against you. Your responsibilities as a director change. You're not there now to generate profits for stakeholders and other shareholders. What you must do is not make the creditors' positions any worse. And that means, you know, racking up more HMRC debts, taking on more supplier debt, knowing that you're going to be going into liquidation down the line. So make sure you take your fiduciary, easy for you to say, Chris, your fiduciary duties seriously. Okay. What are the things that you need to avoid? Okay, one of the things that you must avoid is wrongful or fraudulent trading. And what this means is in a nutshell, it's continuing to trade knowing there is no chance to pay off debts at all, or you're actually purposefully intending to deceive creditors. I'll give you an example. You're a double glazing company. You know you've got no hope of fitting these windows, yet you still go out there and take customer deposits, and you're liquidating owing a shitload to customers in way of customer deposits. That's wrongful trading, potentially fraudulent trading, serious consequences to that. Another thing to avoid, and try not to mix business finances and personal finances. Okay, so always try and keep them separate, because listen, we've all been there. You know, what have you spent that on? And it's like, oh right, crap. It's just going to end up going on your overdrawn director's loan account. And blurring the two, what it can actually do is it can expose you to personal risk. Okay, so business finances, personal finances, keep them separate. Right. So just to conclude, closing down a company, it's never an easy decision, okay? But the right knowledge and a proactive manner and speaking to the right people will ensure, hopefully, the best outcome for you, your creditors, and hopefully make sure that you don't be landed with any personal liability. Please, 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 if you've got any questions, let us know. Give us a call if you need some advice. Chris Worden, First Business Rescue. Thanks for your time.